Thursday, the 5th of February, 2026, silver just touched $87.81. That is not the story. The story is what JD Vance just confirmed about where this price is heading, and why a 50-nation coordination framework announced at the State Department today is about to make everything you thought you knew about this market completely irrelevant. If you think this is about portfolio returns, you are already 10 steps behind what is actually happening in Washington. The Vice President doesn't accidentally mention precious metals policy in economic briefings. When JD Vance references strategic metal positioning in the same breath as Federal Reserve restructuring, that is not commentary, that is confirmation. And when he does it while 26 state treasuries across the country are simultaneously diversifying away from debt instruments into physical assets. And while the State Department is hosting 6 nations to announce a coordinated minerals purchasing cartel, you are watching coordination at a scale that hasn't happened since the gold standard collapsed. Here is what nobody's connecting. Vance didn't talk about gold. He specifically referenced industrial metals with monetary characteristics. There is only one asset that fits that description and trades on COMEX. The same asset that just moved $2.78 in a single session, while posting a 3.27% gain. The same asset that hit a daily high of $92.32 before pulling back. That is not speculation running wild. That is institutional repositioning creating price discovery in real time. While governments worldwide are admitting on official record that the market is distorted beyond recognition. Let's talk about what happens when monetary policy, industrial strategy, and geopolitical coordination become the same thing. You need to understand the mechanism before the price makes sense. 26 states have now introduced or passed legislation allowing state treasuries to hold physical precious metals as reserve assets. That is not a political trend. That is a structural shift in how sovereign entities inside the United States are thinking about value storage. When Texas, Utah, and Wyoming build state-controlled depositories for physical metal, they're not making a philosophical statement. They are building infrastructure for a monetary system that does not rely on New York clearinghouses or Federal Reserve custody arrangements. Vance's comments weren't about state rights. They were about what happens when sub-federal governments stop trusting the vehicle they are required to hold their reserves in. U.S. Treasuries are the constitutional standard for state reserve management. Except now 26 states are passing laws that say physical metal counts as a reserve asset. That is not a hedge. That is an exit strategy being built in legislative language. And it is happening at the exact same moment that the federal government is coordinating with 49 other nations to create a buyer's cartel for the same metal. Here is where it gets structural. The Federal Reserve doesn't control state reserve policy. States control their own balance sheets. When states decide that a portion of reserves should be in metal instead of paper, the Fed can't stop them. They can complain. They can warn about volatility. But they cannot prevent a state treasurer from converting bonds into bars. And that is exactly what is starting to happen at scale. While Washington is simultaneously announcing strategic reserve programs that will deploy direct government capital into mining projects and physical stockpiling. Oklahoma just allocated funds for a state-run precious metals depository. That is not a storage facility. That is a parallel monetary system being constructed with tax revenue. When a state builds a vault, hires guards, implements chain of custody protocols, and creates legislation defining metal as a legitimate reserve vehicle, they're not experimenting. They're preparing for a scenario where federal currency becomes optional for state-level operations, and they're doing it while watching the federal government admit that foreign supply manipulation has been killing Western mining projects for years now. Look at what Vance actually said. He referenced metal-backed stability in the context of industrial supply chains. That is the entire game in one sentence. Silver is the only metal where monetary demand and industrial demand create a supply crisis simultaneously. You can't run a solar panel factory without it. You can't build an electric vehicle without it. You can't manufacture a missile defense system without it. And now apparently you can't run a state treasury without it. And according to the State Department briefing today, you also can't build national security infrastructure without securing the supply first. The math is simple. If even 5 of those 26 states allocate just 1% of their reserves to physical silver, you are looking at billions of dollars moving into a market that trades 43 million ounces per Dalton Y on COMEX. That is not a rounding error. That is a liquidity event. And it is happening while industrial demand is already consuming 985 million ounces per year, with mine supply stuck at 822 million ounces. That deficit gets worse when you add the federal government announcing they're starting strategic stockpiling programs and deploying direct capital into mining operations. Here's the part that makes today's price move different. Silver opened at $83.23. It ran to $92.32. That is a $9 intraday range. but it didn't collapse back to the lows. It held $87.81 into the close. That is not a speculative spike. That is buyers stepping in at every dip, because the bid structure has fundamentally changed. The buyers aren't hedge funds anymore. They're state governments. They're federal strategic reserve programs. There are 49 other nations coordinating purchases through bilateral framework agreements. When Vance talks about strategic metal policy, he is not referring to emergency reserves sitting in a government warehouse. He is talking about active market participation by entities that don't care about quarterly performance. State governments don't have redemption windows, they don't have margin calls, they don't have stop losses. When a state treasurer decides metal is a reserve asset, that is a one-way trade with a 50-year time horizon. And when 50 nations coordinate to form a minerals purchasing cartel, that is permanent structural demand that doesn't reverse when prices rise. That creates a completely different demand profile than what this market is used to. Hedge funds rotate, retail panics, ETFs have outflows, state governments accumulate and hold, international coordination frameworks buy and stockpile. And once the metal goes into a state depository or a national strategic reserve, it doesn't come back out unless there is a constitutional crisis. You are watching supply get permanently removed from the trading float by entities with infinite time preference and zero price sensitivity. Now add a layer in what is happening on the industrial side. The Department of Defense just updated critical minerals guidance. Silver is now classified alongside rare earths in terms of supply chain vulnerability. That is not about price, that is about availability. When the Pentagon says a metal is critical, they're not asking the market for permission. They're securing supply through strategic partnerships, offtake agreements, and direct purchases from refiners. And according to today's State Department briefing, they're doing it in coordination with European allies, Asian partners, and every nation that wants protection from what they explicitly called market distortion beyond recognition. This is where Vance's comments become essential context. Industrial policy and monetary policy are converging on the same asset. The federal government needs silver for defense manufacturing, state governments need silver for reserve diversification, and the private sector needs silver for the electrification build. Out that every government on Earth is subsidizing. Now add 50 nations forming a coordination framework to manage strategic buying, protect against dumping, and deploy government capital directly into mining. You've got 4 layers of non-price sensitive demand hitting a market where the price was set by paper contracts, not physical delivery. That structure doesn't hold. It is not holding right now. Look at the spot price versus the futures curve. Backwardation is starting to show up in the front months. That means near-term physical is worth more than deferred paper. That is the market screaming that settlement risk is now a pricing factor. And it is screaming louder after the government admitted today that foreign supply manipulation has been systematically destroying Western mining projects through coordinated dumping. When COMEX contracts start pricing in the risk that delivery might not happen smoothly, you are not in a bull market. You are in a structural breakdown. And the entities that understand that are the ones moving first. State governments moving into metal right now aren't buying strength. They're buying certainty. They're buying the one asset that doesn't require a clearinghouse, a custodian, or a counterparty promised to maintain value. And they're buying it at the exact moment when 50 governments just announced they're doing the same thing through coordinated programs. Let's talk about what happens next, because the price action today is a preview, not the event. If silver ran $9 in a single session on positioning ahead of state treasury allocations and international coordination announcements, what happens when those allocations actually hit the market? State procurement doesn't happen on exchanges. It happens through direct relationships with mints, refiners, and primary dealers. That metal never shows up on the bid side of COMEX. It just disappears from available inventory. And when 50 nations start executing bilateral framework agreements to secure supply, that is not market buying. That is government. To government offtake that bypasses exchanges entirely. The refiners know this. That is why spreads are widening. When you call a primary dealer right now and ask for an institutional size physical order, you are not getting spot plus 50 cents. You are getting spot plus $3 in a 6-week delivery window. That is not a premium. That is a rationing mechanism. The physical market is already pricing in scarcity that the paper market hasn't acknowledged yet. And it is pricing in something else. The knowledge that governments are about to become the dominant buyers. And they don't negotiate on price. Here is the reflexive loop that most people miss. As state governments move into metal, they legitimize metal as a reserve asset. That legitimacy makes it easier for the next state to pass similar legislation. You are watching a legislative cascade where political risk is actually decreasing as more states participate. The first state to buy metal was taking a political bet. The 26th state to buy metal is following established precedent. And when the federal government announces strategic stockpiling programs in coordination with 49 other nations, that is not just precedent, that is policy framework, and Vance's comments accelerate that process. When the Vice President of the United States acknowledges metal-backed policy as a viable framework, he is not endorsing a fringe idea. He is moving it into the Overton window of acceptable federal discourse. That means states that were waiting for political cover now have it. That means state legislators who were nervous about accusations of gold-bug extremism can now point to the Vice President. His comments in the State Department's 50-nation coordination framework as justification for reserve diversification. The feedback loop is just starting. More states pass legislation, more metal moves into state vaults, more supply leaves the trading market, price rises. More states see metal appreciation in their reserve portfolios, more states pass legislation. The federal government announces strategic reserve buying, 49 other nations coordinate purchases. The cycle reinforces itself until something breaks. Either COMEX defaults on delivery, or the paper price catches up to the physical market, or both happen simultaneously. While governments are announcing they're deploying billions in direct capital, today's 3% move is what happens when the market starts pricing in the first. Order effects, state demand, industrial demand, strategic demand, Federal Reserve programs, and international coordination. But the second order effects haven't hit yet. Those are the effects that happen when other countries realize that U.S. states are diversifying out of treasuries and into metal while Washington is forming a minerals OPEC with every ally on Earth. When foreign central banks see Oklahoma building vaults and the State Department hosting 50 nations to announce coordinated buying programs, they're not thinking about Oklahoma. They're thinking about what the Federal Reserve's balance sheet looks like if domestic entities and international partners stop buying federal debt. That is the real consequence of Vance's comments combined with today's State Department announcement. He is not just talking about states buying silver. He is describing a scenario where the traditional Treasury buyer base is shrinking, because those entities have found a better alternative that now has explicit policy support from federal and international frameworks. And if you are a foreign central bank holding $3 trillion in U.S. debt, that is not background noise. That is an existential question about who is going to bid for treasuries at the next auction when state governments and allied nations are coordinating to buy metal instead. This is why the silver price isn't just about supply and demand anymore. It is about what happens when the asset that competes with sovereign debt starts winning that competition with government support. Every dollar that a state government puts into metal is a dollar that didn't go into treasuries. Every ounce that goes into a state vault is an ounce that the market can't use to settle a short position. Every bilateral framework agreement that 50 nations sign is metal that never reaches the spot market. The trade-off is becoming binary. You either own the paper promise or you own the physical asset. And governments at every level are voting with their balance sheets while announcing coordination frameworks to accelerate the shift. Now look at what is happening in the dealer network. The U.S. Mint is rationing Silver Eagle production. That is not a capacity issue. The Mint has the equipment. They have the staff. What they don't have is enough blank planchettes from refiners, because refiners are prioritizing industrial contracts over retail products. When a refiner has to choose between fulfilling a Department of Defense order and making blanks for the Mint, there is no choice. Defense wins every time. And according to the State Department briefing, defense orders are about to increase because national security infrastructure build-out is now a coordinated international priority that is creating a cascade shortage in retail products that is starting to bleed into institutional supply. The same refiners that make blanks for the Mint are the same refiners that make bars for state depositories and strategic reserves. When refiner capacity is constrained, everyone's competing for the same output, and the buyers with the longest time horizons and the deepest pockets win. That is not retail, that is governments. State governments, federal governments, 50 coordinating national governments, all executing purchase programs simultaneously. Here is what makes this dynamic explosive. Retail demand is noise. It spikes during price runs and vanishes during corrections. Government demand is signal. It is consistent. It is large. And it doesn't stop when the price goes up. If anything, government buyers accelerate purchases during price appreciation because they're not trying to time the market. They're trying to hit allocation targets set by legislation and international agreements. When the State Department announces anti-dumping protections and price floor mechanisms, they're telling the market that governments will buy aggressively to prevent price collapse. When a state passes a law that says 10% of reserves must be in metal, the state treasurer doesn't wait for a dip. They execute the allocation regardless of price because compliance with the law is more important than execution quality. That is the kind of buyer that changes market structure permanently. And you now have 26 states either active or preparing to be active, plus a federal strategic reserve program, plus 49 other nations executing coordinated purchases. That is not a bull market. That is a structural regime change where governments become the marginal buyer. Vance knows this. That is why his comments weren't casual. He is watching the same data everyone else in Washington is watching. He is seeing state reserve diversification, industrial supply constraints, and COMEX inventory declining while open interest stays elevated. He is seeing the State Department host 50 nations to announce coordinated intervention, and he is connecting those dots in real time while speaking publicly about metal-backed policy frameworks that align with international coordination efforts. The question isn't whether silver goes higher, the question is what breaks first. Does COMEX run out of deliverable inventory? Do premiums on physical metal get so extreme that arbitrage becomes impossible? Do state governments and international coordination frameworks start buying directly from mines and cutting out the exchange entirely? All three of those scenarios lead to the same place, a paper market that can no longer set the price, because the physical market has decoupled completely and governments control the flow. Today's price action is a tremor. $87.81 is not the top. It is not even the middle. It is the beginning of a repricing event that happens when monetary demand, industrial demand, strategic demand, and coordinated international government buying collide in a market that was designed for none of those things. COMEX was built to handle speculative flows and jewelry fabrication. It was not built to handle state governments, federal strategic reserves, and 50-nation coordination frameworks fighting over the same limited supply while announcing they're deploying billions in direct capital to secure sourcing. The entities that understand this are moving now. They're not waiting for confirmation. They're not waiting for lower prices. They're buying at $87 because they know what happens when the market realizes that the available supply is already spoken for by governments that just announced coordinated purchasing programs. And when that realization hits, the price doesn't grind higher, it gaps. Because there is no orderly transition between a market with surplus and a market in deficit where governments control buying. There is just a discontinuity where the bid side disappears and the offer side moves exponentially because physical delivery can't meet coordinated government demand. If you are holding paper silver, you need to understand what settlement risk means in this environment. When a COMEX contract comes due in the clearinghouse and they can't source metal, because it has already been allocated to state depositories, federal strategic reserves, or international framework agreements. Your paper contract doesn't convert to metal. It converts to cash at whatever price the exchange decides is fair. And fair in that scenario means whatever prevents a systemic default, not whatever reflects true market value in a government-controlled buying environment. Physical delivery is the only trade that matters now. Everything else is exposure to a system that is optimizing for its own survival, not your returns. And when J.D. Vance stands up and confirms that metal-backed policy is under serious consideration at the federal level, while the State Department simultaneously announces a 50-nation coordination framework for strategic buying, he is telling you that the system knows the paper game is ending. The free market experiment is over. The government intervention era has begun. He is just not telling you exactly when the final break happens, but it is starting to reveal itself in the price. $92.32 intraday, $87.81 at close. A 3.27% gain on a Thursday with no crisis headline. Just a vice president confirming metal-backed policy discussion, and a State Department hosting 50 nations to announce coordinated buying programs and anti-dumping protections. That is not speculation. That is reallocation. That is governments at every level signaling they're becoming the dominant buyers. And it is only going to accelerate as more states pass legislation, more nations execute framework agreements, more refiners prioritize government contracts, and more market participants realize that the supply they thought existed is already committed to entities that don't sell. This is the new structure. This is what happens when industrial necessity, monetary strategy, and international coordination become the same objective executed by governments with unlimited capital and zero time preference. And this is why Vance's comments, combined with today's State Department announcement, matter more than any analyst report or technical chart. They're not predicting the future. They're describing the present. And the present is a market where the buyers who don't care about price are taking all the supply before the buyers who do care about price even realize that governments just formed a purchasing cartel. Silver at $87 isn't expensive. It is mispriced relative to a new reality where governments coordinate buying and announce strategic stockpiling programs. And the correction to that mispricing doesn't happen in 5% increments. It happens in violent resets where the offer side moves faster than the bid side can process. Because physical supply can't meet government demand that is now coordinated across 50 nations. The only question left is whether you are positioned before that happens, or whether you are trying to chase it after the gap, when governments are already executing bilateral agreements that bypass exchanges entirely. The 5th of February, 2026. The day J.D. Vance confirmed metal-backed policy consideration. The day the State Department announced a 50-nation minerals coordination framework. The day governments admitted the market is distorted beyond recognition and announced they're intervening to control it. The day everything changed about who sets the price and who gets the metal, physical or paper, government coordination or market forces. The choice is becoming binary, and time is running out to be on the right side of that choice before the paper market realizes it no longer controls the physical one.